What having $1 million in your 401k really means, and how to make it last. By William T. Stevens, entrepreneur, investor, blogger. $1 million in your 401k used to sound like the golden ticket to a stress-free retirement. But in today's economy, with inflation, rising healthcare costs, and increased longevity, is $1 million really enough? In this episode, we'll break down what having $1 million in retirement savings truly means, how long it can last, and smart strategies to stretch it further. The monthly breakdown. Let's keep it real. If you retire at 65 with $1 million and withdraw 4% annually, a common rule of thumb, that's $40,000 per year or about $3,333 a month before taxes. That income might work if your mortgage is paid off and you live modestly, but if you're still carrying debt or plan to travel, it may fall short. Taxes will still apply. If your 401k is pre-tax, Uncle Sam is still waiting. That $40,000 could shrink fast depending on your tax bracket. You may only keep $30,000, $34,000 annually after taxes. Your $1 million dream is more like a $2,500 a month reality after taxes. Inflation is the silent killer. A dollar today won't be worth the same tomorrow. At a 3% annual inflation rate, your purchasing power drops significantly every decade. That $3,333 per month won't stretch nearly as far at age 80. $1 million today equals $744,000 in 10 years if inflation averages just 3%. Healthcare and longevity risk. Medical expenses and long-term care costs can eat through savings fast. Fidelity Investment Company estimates a retired couple may need over $300,000 for healthcare alone. Consider long-term care insurance or building a health savings cushion early. Don't leave it idle, invest wisely. Your money still needs to grow. That means allocating smartly between income-generating investments, inflation-resistant assets like real estate or REITs, and some growth stocks. Retirement is not the finish line, it's a pivot point in your investment strategy. Diversify income streams. Relying on a single 401k is risky. Supplement with Roth IRAs, real estate, side hustles, or passive income vehicles. If your only retirement income comes from one account, your future depends on one roll of the dice. Delay retirement if possible. Working even 3 to 5 more years can supercharge your retirement. Delay Social Security equals bigger checks. More contributions plus compound growth. Less years drawing from savings. Tip: if you're healthy and motivated, consider part-time or passion work post-65. Final thoughts. $1 million isn't what it used to be, but it's still a strong base if you play it smart. Stay informed, stay diversified, and stay disciplined. The key isn't just how much you've saved, it's how well you manage it. Like, share, and subscribe for more honest wealth-building advice every week.